would not be crazy for you to feel like you had deja vu with this week's headlines on the news, on the freaking internet. I mean, every news article that repeated the historically high interest rates for the past 20 years. You guys have literally read this multiple times in the past year, and it started at around this time last year when interest rates peaked and we saw housing values start to decline and a real big slowdown in real estate transactions. And this week it felt like, oh my God, is that happening yet again? So a lot happened this week and a lot didn't happen this week. And I also saw articles referencing 8% rates, and I want to tackle that in today's video. What does this mean? Because if I was a consumer, I would be wondering if homes are even affordable in the marketplace and if the dream of home ownership was even achievable anymore. And so for those of you who are new to the channel, my name is Lizy Hoeffer. I'm a residential loan officer at Cross Country Mortgage, and I like to teach practical money tips so you guys can make smart home purchases. So one of the things that I do not want to do is make light of the fact that housing has become less affordable in the United States. For me, it's really sad that there are 3 to 5 million Americans that are on the sidelines because they either cannot qualify for a mortgage in the 7% or they feel like they can't afford it within their budgets. If you've been a fan of this channel, you know that housing and real estate has made a huge impact throughout my entire life. When I was a young girl, my mom, young adulthood, and into my adulthood, it's how I've actually been able to grow my portfolio, and I've helped hundreds of families start their wealth journeys through their primary residences. And so I'm very passionate about real estate, so it makes me very sad. And I was reading an article from a popular newsletter that I subscribe to from Anthony Pompliano, which was talking about, the dramatic impacts of affordability in the United States when it came to housing. And there were some interesting statistics from Lance Lambert of Fortune magazine, and he was saying that in order for housing affordability to return to pre-pandemic levels, either US incomes would have to rise by 69%, or housing values would have to drop 41%, or interest rates would have to go back under 3%. As somebody who works in real estate, as somebody who watches finances pretty closely, my professional opinion is that housing is going to be less affordable indefinitely. Do I think it's going to be this bad? Probably not, but I do think that a lot of the marginal buyers that were barely scraping by to purchase, I think they're probably priced out of the market now. That does make me super sad. I was running some numbers just on a $450 purchase price with 5% down, like how much of a housing payment increase did somebody see from 4.75 to 7.25%. It was about $686. And that's a huge difference. And it definitely impacts people's buying budgets. Typically when interest rates go up 1%, it lowers a buying budget by 30%. People either have to put down larger down payments or be more strategic when it comes to buying out mortgage insurance or the type of financing. It's a huge difference. If you are somebody that wants to buy, a couple things that you have to pay attention to are your overall budget. I've said this in a variety of different videos, but two things that I want to mention because I thought that this was pretty substantial when we're talking about almost a $700 increase is are there easy cuts for you guys to make? And one of the easy cuts, guys, is eating out. Like the average household spends about $300 a month eating out. And there's about $219 in reoccurring subscriptions. And so no, that doesn't equal the total amount in this increase in housing. These are places that you can look to within your budget to try to kind of bridge that gap. So I want to shift gears right now and get off a little bit of budget because I've recorded a couple videos on that, but really talk about what happens if interest rates go to 8%. That will happen if there is another Fed rate hike. And what we saw last year was a real big pullback in terms of transactions. So last year when interest rates, got to the 7s, we saw about a 10% decline in values here in the Valley. Now that changes depending on the municipality, the city, the state, wherever you're at geographically. So you're gonna wanna talk to a real estate agent, but we saw a decline anywhere between 10 to 20% depending on the area. There was a decline in home values, and then there was a pretty substantial decline in the number of transactions. Now, I've heard a variety of news articles reference a housing crash when they talk about last year, and they're not talking about a crash in home values the way that we think about when we think about the Great Recession, but there has been a substantial decrease in the number of homes being listed on the market. And just to kind of give you some perspective, because there was a really good interview with Logan Matashami that talks about housing costs. So basically the number of homes that are listed on the market for the country, about 4 million. And we have 156 million people working. We have like, I don't know, like a 2.5 to 3 month supply of houses. And that is anything under 6 months is considered a pretty significant seller's market, which means that it's very competitive. And so when you think about the people that are buying today have cash and are well qualified, the demand that's still available, it's meeting this supply. And so homes are actually more expensive than they were last year, even though people reference a decline in home values and they talk about this crash, right? We're not seeing that home values are going down. We're not seeing this massive wave of inventory hitting the market. In fact, housing is rather insulated. I mean, 47% of people own their homes free and clear. 85% of people that have a mortgage less than 5%. And so they're in housing favorable conditions. And if interest rates were to go up 8%, there would be even less housing inventory, which means that there'll be even less transactions done, which means that there's less a chance for this huge bottoming out of home values. So I hope that that helps make you feel better about a real estate investment or a real estate purchase. It does not make you feel better if we're talking about actual cost of house. My professional opinion, having worked in mortgage for 21 years, is that if interest rates do remain in the 7s or, close to 8%, is that if they show a longevity in this direction, so like the economy does not go into a recession, there will be a stabilization of mortgage-backed securities, and interest rates from that point in time should get better. There's just not a long enough yield curve for investors to want to get into mortgage-backed securities, because there is a high likelihood still that there is going to be a drop in rates that leads to a massive wave of refinances, and investors are looking at long-term returns and they're just not seeing it in mortgages. And so that's why there is a lot of people saying buy now and refinance later. So there's a large chance that there will be of time to refinance in the future. But let's say interest rates do stay historically high, what happens? Well, creative financing products do start rolling out. So you see longer amortizations like 40 and 50-year mortgages, and you see things like ARMs, which are called adjustable rate mortgages, which means that there'll be a fixed in interest rate somewhere between 3 and 10 years. It'll be lower than where current market is, and then the rate will adjust for wherever the market is when the home loan reaches that whole fixed period of time. That's my perspective on what will happen. I do think that, a third of the, 30% of the US economy is based in real estate and real estate-like verticals. So they cannot keep it unaffordable or affordable at this pace for very long. My professional opinion is that it will get better and more affordable. It's very hard to predict when. So if I was a consumer trying to buy in this marketplace, I would be buying and being very, very observant of where I'm spending my money. I would try to decrease my expenses in terms of things that I don't need, in terms of like eating out, buying unnecessary clothing, reoccurring subscriptions. I would be more conservative in areas that you don't need to spend money on. I would also be looking at, different loan products, larger down payments. I would be seeking out maybe purchasing with my parents, right? If generational housing was an option for you. I mean, there are ways to make housing more affordable even in this time period. And I'd love to answer any and all of those questions. And if you guys have a video topic that you'd like me to break down, please, by all means, guys, share it with me in the comments below. That's gonna wrap up this week's video, guys. If you have any questions at all, like I said, put them in the comments below. And I will be back next week with another market update video. Until then, guys.